Well, good afternoon, ladies and gentlemen. My name is Nick Wilson. I'm with Oxford Economics. Most of you might know us as a macroeconomic forecasting business, but recently we've set up a real estate economics service. It's certainly been an interesting time to be doing that, given all the movements that we've seen in the market. And definitely Australia and Singapore are two markets that we're very focused on at the moment. So before we kick things off, I might just ask the panellists to give a very quick introduction, just name and tell us what you're up to in Australia, and then we'll kick things off.
Yes. Thank you. And I'm happy to see that there is more attendees in the room than panelists on stage. So I'm Laurent Fischler. I work for Ivanhoe Cambridge. We're the real estate investment arm of CDPQ, the Quebec Bank of Savings and Deposits. And I'm the head of investments for Asia. And we're quite active in Australia across residential, industrial, office, and other sectors.
Hi everyone, my name's Trent Windus. I'm the head of the Australian investment team and the Asia Pac debt team for Phoenix Property Investors. So we're a Hong Kong-based private equity firm that manages credit, opportunistic and core plus capital, 100% real estate, 100% across Asia.
Hi everyone, my name is Sharon Sng. I'm head of sales at SDAX. We are an investment and trading platform, MAS licensed digital exchange. We specialize in the private markets, which just means that we are effectively distributing private credits, private funds, and our twin focus is real estate, which is obviously why we are here today, and ESG.
Good afternoon. Fergal Harris is my name. I'm the head of capital markets for Australia and New Zealand for Jones Lang LaSalle, and that covers all of our investment asset sales business, office, logistics, industrial, retail, alternatives, and our equity and debt advisory practices, and also we have an embedded ESG function. That's me.
Okay. So, obviously over the course of this year, I think the biggest topic we've seen is really what's been happening with inflation, with interest rates, and the cost of debt. Certainly the clients that we've been speaking to have shown a bigger appetite now for also operating in the debt space and becoming lenders. So Trent, I might start with you. Obviously, you're, as one of your hats, is your head of debt for Australia. Can you just tell us a little bit about some of the opportunities you're looking at in Australia in terms of where you see the opportunities, but also where you want to sit on the risk curve? Are you looking at senior, stretch senior, or are you looking a bit more further up the risk curve, away from the traditional domain of the banks, up into the mezzanine lending area?
So we're focused on the high-yielding part of the market, so the non-bank space, the more opportunistic space. I think this market, the volatility that we all know is happening, we've talked a lot about it today, creates a lot of opportunity in credit. So I think if we look at what's happening in Australia specifically, the banks are still fairly supportive of core. The banks are fairly supportive of development or repositioning assets if you have the absolute perfect asset. So it's a unicorn. Given what we've seen happen in volatility in the markets, that's very, very rare. So then nearly all borrowers are being pushed into this non-bank space. And they haven't got a choice right now because of what's happened with the markets, costs, rates, values. So if you're lucky, if your project or your development or your asset is feasible in the non-bank land right now, so you can borrow from the non-banks and it's still a feasible project, but a lot aren't. So we've seen a lot of projects getting shelved and not happening and stalling. So I'll give you an example where we have an office, Sydney CBD redevelopment right now. We're lucky enough that we can get non-bank debt to kick this project off, thankfully. So we're lucky, but we're paying early single digits return for senior debt. So when we're in our equity business and we're underwriting deals and it feels like we're on a treadmill. One day we think we're buying cheap, the next day it's expensive. So if we're looking at our credit business and we can kind of do senior debt at 12, 13%, mezzanine debt mid-teens and higher, and you've got all the built-in protections, we think that's a fantastic place to play right now. And the Singapore-Australian connection, some of the biggest Singapore investors are also the biggest investors in the credit space in Australia and have been over the last couple of years.
Very interesting. And Fergal, you've certainly been around the block a few times, in the debt space, I mean. So that you've worked in Singapore.
Clearly quite a lot of people in this audience will find that funny, Nick.
So you've done, in the debt space in Singapore and Australia and elsewhere. What are you seeing at the moment in Australia from an opportunity standpoint? And given the change in the cost structure, are you seeing this as a potential catalyst for a more permanent shift for a deeper non-bank lending market in Australia?
The short answer to your question is yes. The reason why I say that is because the rise in rates not only gives private debt funding more attractive returns, it is also sort of breaks the formula that has governed the four-bank pillar in real estate. So if you take it back to 2014, when the Aussie banks sort of adopted a very draconian standardised approach to how they lend and the cost of lending, and that sort of gave rise to the first wave of non-banks. People are under pressure. Interest coverage ratios are under pressure, will be under pressure for the first half of next year for sure. And formulaic-driven, highly regulated banks will really struggle to be flexible with that environment. And it is just 50 LTV was a nosebleed LTV for investment assets that weren't high, really solid core end of town to a bulletproof counterpart. So that model is broken. And that model is not going to get fixed by Citibank or by Standard Chartered Bank or UOB coming into town and picking up, where in previous cycles we saw sort of local banks get replaced by ambitious and flexible international banks. That part of the market is now going to have to be filled by private credit. Credit that would typically like that asset, would have bought that asset, didn't have an opportunity to buy that asset, so will get in through the credit space. And that's not to say it's a loan to own. It is an opportunity to get into the space, down the risk curve, we can say risk adjusted, but enjoy a return for a repositioned asset or an asset that's in mild distress that previously that investor who's now accessing through the credit market would never have had a look at that sort of scale. And we've seen the raising of, I'm going to just off the top of my head from what I can remember, $2 billion in the last 6 months. Capital raised to hit the credit markets next year. So that's not going away. That is now a trend. And it's going to be really, really interesting to see the competition for credit in the unregulated space. Yeah.
Yeah, I'm just going to quickly jump
Sure.
in on top of that. Because we are in the private credit space, right? So we've seen the growth in private credit just globally. It's gone from 1.2 trillion, and it's going to go to 2.7 in 4 years. It's a 17% CAGR that we're expecting. And specifically in the Australian market, I think Singapore has been a key driver and supporter as an alternative lender into that market, because the Singapore capital has just been very comfortable with that space, and in terms of the property development specifically, as an alternative source of capital, right? And because the four banks have been so stringent in their covenants, this alternative source of capital from the Singapore side has been present for a long time. And increasingly, the private capital from the Singapore source has been growing because of that. And we have seen a lot of flows, from SDAX, and we have increasingly been able to play a little small but growing part in terms of being an aggregator and being able to fractionalize that participation from various, be it family offices or other alternative capital providers, and able to just plug that gap, right? And able to see and play in that space in hopefully in bigger forms going forward. Yeah.
And Sharon, just from an SDAX perspective, I actually set up an account in preparation for today. Very simple.
Thank you.
I'm not being paid for that. But look, I know that it really does open up a new avenue for a range of different, investors, from, small-time retail investors, private, high net worth, and others. Is this, do you see this happening on scale? Like, where is SDAX, able to, can you give us a sense of where you're adding, to the more traditional markets?
Well, I think the main angle here is a lot of investors are now, especially in this current environment, right? They are looking at their portfolio and looking at investments in a place where they want to continue to invest, but yet they don't want to take on risk unnecessarily. So they want to spread their risk, right? So they're always in the mode where they say, can I co-invest? How can I spread my risk and take on a risk in a manner that I am comfortable with, right? So they want to moderate their risk, and they want to always invest with the smart money, as they put it. So this means that for every single risk that they take on, they also want to calibrate it very carefully. So the whole purpose of the platform is to be able to fractionalize and able to allow co-participation with lots of different parties. So no matter how big you are, you still have the option of scaling your risk to the pocket size and the checkbook size that you have, right? So even if you want to write a $5 million check or $100 million check, the baseline of that investment could still be a $2 billion asset size, or it could be a 200 million asset size. It doesn't matter, right? The fact is you have the platform and the ability to scale it accordingly. That's the beauty of the platform.
Thank you. Now, I think we'll change tack slightly. Touching on some of the other themes, and some of this has been mentioned today. Obviously, changing workplace strategies, technology, as we've heard, and certainly ESG are growing trends. Now, Lauren, I think it was only a month or so ago that Ivanhoe and the consortium developing the Moorebank Industrial project has announced this incredibly large solar rooftop project. Can you give us a scale of the size of that, where you see this going in the future, and mostly from an Australian perspective, but is this also applicable to other markets as well?
Sure. So Moorebank Logistics Park is it's a very cool project, actually. And a lot of people think that sheds are boring, but actually this is a really exciting project. So Moorebank is 243 hectares piece of land in southwest Sydney. We're going to be building about 850,000 square meters of logistics, and it's the largest intermodal logistics estate in Australia. I think the GDV is going to be in excess of $4.2 billion. And so we've just announced this partnership to do solar panels on the roofs, which we are rolling out in most of our estates in Australia and across the region. But we're going to have initially 60 megawatts of solar panels and battery capacity and an embedded network. And potentially that could go up to 130 megawatts. So that could service the whole estate. 60 megawatts is probably about 40,000 homes in the greater Sydney area. So it's pretty significant. The other cool thing about Moorebank is it's actually got a direct rail link to Port Botany. And so we're trying to take about 11,000 trucks off the roads by having the containers shipped by train rather than road. So relieving congestion and pollution and solar panels for renewable energy. So and it makes money.
It's always a good thing, I suppose. Yeah. Fergal, I think we've spoken about this before. There seems to be also a bit of a bifurcation in the market from an ESG perspective, partly driven by tenants, partly driven by investors. So, how do you see this playing out between the sort of top end of town all the way down to the very bottom? Obviously, buildings in between can probably be brought up to speed, but there's also that lower end of the market where we'll need to find something else to do. So how do you see that all playing out from sort of top to bottom?
Yeah, let's deal with the top end of town. We've witnessed net absorption, increase in absorption in leasing as a migration towards quality. And I suppose at the end of every cycle, and beginning of every new cycle, there's a flight to quality. The difference in quality this time is it's going to be ESG led. Quality is going to be defined by your environmental and your sustainable credentials. And many buildings in Australia, and I dare say around the world in major metros, are at that level where those credentials would pass muster just yet, enough to attract the current occupancy. So the first point I'd make is that if you're looking to attract tenants, global tenants, high quality tenants, it is just a given. It is beyond debate that you need to have environmental and sustainable credentials that are consistent with your tenants and their aspirations. In addition to which, your tenants also have employees. And I think somebody said you've got to earn the commute by bringing those employees back to the office. You have to, the end of trip thing doesn't really cut it anymore. It needs to resonate with that younger cohort of staff that want to be associated with that office, want to be in that office, and want to be feel that their sense of community, in addition to the environmental policies of their employer and landlord, are met. So that's certainly part of what's happening in that space. In addition to which, and we go back to, not to go back and dwell on the debt piece particularly, but to talk about sort of how finance will play a role. Banking institutions will not fund a project that doesn't have cash cover or doesn't have an exit. So you're going to need those tenants in order to fund those interest payments and in order to maintain that value. So that's the third leg of why you're getting those high quality migration being driven by environmental and sustainable credentials. So they're the winners, and there will be some losers, and there will be people in between that are neither here nor there just yet. At the bottom end of town, I think Jeff Perlman said it earlier, if he's still around, about the vast majority of people in this market haven't lived through too many cycles and haven't seen what happens to assets that are no longer fit for purpose when the market turns. There will be obsolescence, there will be redundancy, there will be significant properties that are of an age that cannot be refit or retrofit. They will be repurposed into something else, and it may very well be, to take an asset class in Australia, may very well be residential, just because of the dearth and the chronic shortage that we have there. So at the very bottom end of town, you are going to see landlords get caught out, not be prepared for what comes next. And in the middle, you've got a choice. You either have the money to change your asset and retrofit that asset to be attractive to tenants. Not all assets are the same size, but let's just stick with a theme. Or you won't, and you will sell to people who do. And that is where the migration of, at least of office stock, is going to go. That's assuming vacancies and economic activity and all things being equal. But in terms of occupancy, getting people back into the office, it's going to have to be environmental, sustainable led.
Yeah, I suppose new uses into the future will always remain a question, but we'll get to the residential piece soon, because that's obviously some strong drivers behind that, but some headwinds as well. Sharon, just from an ESG perspective, when I was looking online at various opportunities, obviously SDAX has an emphasis on ESG. Are you seeing that as a means whereby private investors and high net worths can sort of future-proof their own investments and target ESG sustainable assets?
Well, yes. I think what we've seen is that impact investing has actually increased about 40% in the last 2 years. Now, these strategies to actually seeking to so-called save the planet and its people, targeting specifically on the environmental and social side of things, has now sort of reached about 1 trillion in terms of the global impact side, and at least 21% of the world's largest public companies have committed to meet what they call the net zero targets, right? And these companies represent about 14 trillion in terms of their revenues. So we see that the investors are actually increasing their awareness of these need to be at least aware of this social impact investing. So for our side, we're very committed to identify these companies, to at least create that awareness as well. So you will see more companies that we put on the platform that are raising funds to make these options available for investors, so that we also are being part of that revolution to do what we call financing the transition to net zero. Right? So increasingly, we will put more companies, and we have a chief sustainability officer that will be, be part of the revolution to diligence the companies that we put there to make sure that they are complying with all what they are actually doing, what they say they're doing to comply with the scope of the sustainability objectives.
Thanks. And I think I mentioned earlier residential. I want to change tack towards residential, and when I say that, I mean more broadly living sectors, BTR, PBSA, and even residential development, of course. And Lauren, obviously BTR very fast growing, but still quite a young sector in Australia. There seem to be some tailwinds at the operating level, very strong rental growth, record low vacancy rates in the broader rented market. So obviously some opportunities there and some challenges. How are you seeing that segment of the market? Are you looking to build more pipeline in the BTR space and the PBSA space over the next year or two? Or are you looking to consolidate on what's currently in the pipeline?
Sure. So we've been doing BTR in Australia for a couple of years now with some of our partners. And I think while the sector has very strong tailwinds, as you've said, and vacancies are low, rents are rising, everything looks great. There's a lot of capital chasing the sector, so it's become very competitive. There's a lot of high-profile names in there. We're also in an environment where interest rates have been rising, as you've discussed, so the cost of debt is going up. Construction costs have exploded over the past 18 months. And yet the people selling land don't seem to have got the memo, and they're not really adjusting their expectations. So there's a bit of a mismatch, and it's been pretty hard to deploy, if I'm entirely honest. One of our frustrations is we would like to deploy more in that sector, but it's hard to get good deals, to meet your return targets. We do like PBSA a lot, and we've been looking at that sector and hope to be able to do something there. And we also hope to do more in multifamily BTR. We've also been looking at specialized accommodation, for disability housing provision, and other sort of niche sectors, just to try and look at the broader spectrum of the living sector.
It's interesting you say that the pricing and investor demand is really holding up, and there hasn't really been an adjustment off the back of interest rates. Do you see that as a potential disposal opportunity? And if so, should you speak to Fergal?
No, because all of our stuff is under construction right now. It's not finished. We'll be talking to you sometime.
That wouldn't stop me taking a mandate off you.
It's a fun fruit.
Don't worry about that.
Okay, Trent, I mean, from a residential development perspective, Phoenix have a joint venture development in Sydney's inner north, so a very prime area. How are you seeing the sort of investor demand for completed units in that sort of prime segment of the market? And Singaporean investors, of course, over the years have been a very active participant in Australian residential markets as well. Are you seeing any demand from Singaporeans, or is it largely domestic focused?
So we actually have 8 projects on the North Shore. So we do like that smaller boutique, really high quality development space. So we actually set up a platform with a very large Singaporean investor to develop a number of those projects, because we see the demand, or we have seen the demand and supply being quite compelling in that apartment market, especially for higher quality. So when you look at some of the numbers that are coming out on supply, which is a big driver for our thesis, to the last financial year, to 30 June, there was about 7,700 commencements of apartments in Sydney. In 2017, there were 31,000, and in 2013, there were 14,000. So supply is coming off an absolute cliff. There's 1 million people with visas backlogged waiting to get into Australia, to which the government's increased the immigration caps, where we forecast around 600,000 people to come to Australia to live by the end of 24. Plus we're getting like 10-year or decade highs in student applications for visas as well. So demand supply, we think very favourable in that sector. Of course, any project right now has serious challenges getting out of the ground. So construction costs have come up 20, 30%, and we've talked about interest rates a lot. So in that space, I think there's sort of two projects that like Fergal was talking, the winners and the losers. The winners are those projects that are good quality, strong locations that can be differentiated and probably smaller. And there, what we're seeing is they can get out of the ground and there is demand for them. So it's a bit more of a price maker type asset. And we've just launched a project where, we put the prices up significantly above where we were thinking. And that was really to recoup all the costs that we've incurred in construction, etc. And they didn't fly out the door, but the market certainly accepted it. And I think that price is set. So it seems like the market's starting to accept prices and accept that if they want this product, they're going to have to pay and come up with the money. I think the smaller, the cheaper end of town, that's while we see great demand, I don't know how the projects are going to get out of the ground and feasible. In terms of Singaporean investors at the higher or the premium end that we're selling, we haven't seen a lot of demand from them. They're typically more towards that more investor-friendly product, so higher yielding. Maybe cheap is a bad word, but more fairly priced for renters. And anecdotally, we see a lot of Singaporean investors take advantage of the depressed pound and heading to London. So that's our experience in those markets right now.
And
Just jumping in,
go for it.
if I may, just on BTR, because obviously I'm immersed in it daily, and it's presumably like Trent, we're hearing about it constantly, and I think you can't really talk about BTR in Australia and talk about an MIT tax code change unless you talk about social and affordable housing. Those million visas, or that 250,000 people that are going to eventually come through that Australia needs for growth. Migration has been the cornerstone and bedrock of Australian economic growth since the dawn of time, or since the beginning of the country. So unless that social and affordable is addressed, I don't think you're going to see a government change the tax code in order to change that middle income BTR space, which is where that investment is, which is where those explosions of development in Melbourne are. I think that's close. I think the government are going to struggle to extend it to middle income housing, but they're going to need to. If you're going to attract the sort of the immigration that we need in order to continue growth in the long run, you're going to social and affordable you can solve for, but you're going to absolutely have to lob in middle income on that as well.
And just on the affordable housing, I'm not sure if I missed it there. Is that an accessible market to foreign investors like Singaporeans and others?
Yeah, I think it is, and I'll tell you why. I think there's two reasons. One, global investors are socially conscious. I mean, to be involved in a project or projects or a movement, it is a huge movement in Australia around the various states. To be involved in that is important for a lot of investors. And you talk about impact investing. There's a lot of investors would be very interested in being involved if they can get the returns. That isn't the gift of the government to give tax incentives, because ultimately that's going to be 75% of market rent. So who makes up the other 25%, or how do you make up that other 25% through tax incentives or removal of rates or whatever it happens to be? I think it is attractive, and it is also scalable.
Yeah, it's obviously an emerging, or from an institutional standpoint, emerging. I mean, have we got any sense on what the pricing looks like, either, from do these need to be developed, or is there, assets that can be traded on a yield basis? Do we have an idea of what that pricing is?
There's no stock. Yeah, not yet. Okay. It needs to be developed. I mean, we're way behind.
Yeah, I mean, I guess on the broader BTR market, pricing has always been a question mark in Australia. There was talk about yield on development cost at 4 or 4.5%. Lauren, do you think that might be increasing just given the cost of debt, or is there's potentially other factors to consider?
I'm I'm drawing a blank. I sort of assume you'd need to have some sort of cap rate expansion with the interest rates going up and the hike in construction costs. But in terms of numbers, I'd be hard-pressed to give you an actual number, sorry.
No, I guess it's a fairly, still emerging sector, so it's not like there's a lot of stabilised transactions at the moment. So I want to maybe touch on a couple of individual themes for each of you. And Sharon, I'd like to start with you. Obviously, SDAX is bringing this new technology to the market. It's digital assets based on blockchain technology backed by the commercial real estate. And let me know if I've got that wrong. Can you just tell us a little bit about that and the idea around the investment structure? So how does blockchain technology make this different from other types of traditional investment?
Well, actually, it doesn't really. I mean, the blockchain technology just makes it more efficient in terms of if you think about things like the ability to make distributions and ability to do reporting. So for NAV reporting to your investors and also your financials, and ability to make your distributions out, let's say your cash distributions or your dividends, for example. So it makes it a lot easier and faster and cheaper, right? So that means it's, but in terms of your cap table or your loan structure and your equity or debt structure, it's actually the same. So if you have 70 or 80% LTV, it's actually exactly the same. But let's say, for example, if you have a private equity fund, in the past, we are able to provide secondary liquidity. So for example, a private equity fund, which would typically have a 5+1+1 structure, where all your LPs or GPs were typically locked up for 7 years. Now, if it's tokenized and put on the exchange, you could provide secondary liquidity for all your LPs, right? So this would actually completely change the nature of the participation in that private equity fund, right? So the nature of your investment theoretically changes completely, right? So I think that is something that would change the nature of you going into the private equity investment from day one. So I think that's what we are trying to revolutionize in terms of the way you think about going into private equity, for example. So every single investment that you go into, even if it's a private credit, if it's a 2-year or a 3-year or a convertible for that matter, you buy it, you invest in it today, you could theoretically trade it out next week.
It certainly opens up, more liquidity or removes the requirement for that secondary market, which can be, quite difficult.
Exactly.
Lauren, Ivan have done a lot of different kinds of structures in terms of their investment strategy in Australia. You've got obviously these direct and joint venture partnerships, consortiums, as well as being an LP in funds. Can you tell us about, particularly for a foreign investor standpoint, have you personally got a preference of where you want to take that moving forward, and any sort of hot tips or ideas for other investors looking to access a market like Australia?
Yeah, I don't know about hot tips. But I guess it depends on on each investor's individual preference. We tend to favor joint ventures and club deals. So small partnerships with like-minded investors. Our team is too small to do complete direct investments. We do direct in Europe and in North America, but here, stretched out over all of Asia Pacific, and with small presences in these markets, we don't really have the capacity. So we've been focusing on finding good partners and either doing joint ventures, or if it's a larger scale project like Moorebank, setting up a club of 3 or 4 co-investors. We just don't do that many funds in general, which is more of a, I guess, historical or ingrained preference. But you know, I suppose there's a lot of good funds out there for entering Australia if you're so minded and if it's your first foray. Typically, we'll do funds for when we go into new markets where we don't have a lot of experience, to get a bit of exposure and market knowledge and find new contacts. That's pretty much it. I mean, in terms of opportunities in Australia, we're keen still to do more in addition to the residential and industrial. You know, everybody's talking about life sciences. There's a few life sciences opportunities in Australia, but very hard to get by, and returns have been very, very tough. I think also healthcare. People are talking about childcare. We're starting to think that cap rates for retail are almost high enough that it could be attractive again. So there's certainly a lot of things to look at.
Yeah, it's interesting, and even today, from a retail perspective, there's been some rare positivity. You know, obviously, you know, yields haven't compressed in that sector. Fergal, you know, we haven't spoken about the retail sector, but you know, obviously, some have seen it as a bit of an ugly duckling over the years, but you know, it seems like this year it might be a bit of a quiet outperformer. Are you seeing that sort of across the board of retail, or is that more segmented, you know, across the different subtypes of retail?
Yeah, there's a couple of things. Well, firstly, 2021 was 13.6 billion transacted in a market that typically transacts about 6 to 8 bill. So for those outside Australia, retail was a really, really, really popular asset class. Fundamental retail, real estate rich suburban retail that's anchored by Woolies or Coles, which is cold storage for the locals. It is very, very, very well supported, very, very popular, very low vacancy, highly resilient tenancies. The other thing I'd say about retail, and I think it goes back to how retail was treated pre-COVID, it took its medicine really quickly in this downturn, and when interest rates blew out, I mean, trades that we're doing at the moment are in the low sixes, and that was a quick turnaround from low fives. And it wasn't to get stock shifted, it was just a recognition of the fact that, look, we've been here before as retail, that is what it is. And if you look through the cycle and you think early sixes could turn into fives when interest rates start coming down back end of 23, you're a buyer. So Laurent, come on down and see us. We've got a few trades in the market that are a bit slow. We might need your help. But so that's in that fundamental food anchored, I suppose, really plays the demographic of Australian metro, and smaller towns of sort of Queensland and Victoria, New South Wales. Large format retail, malls, shopping, you know, really big malls, shopping centres, not so much. Just very, very large scale, not a lot you can really do with them, and trading off very, very low, tight yields that investors want to maintain. So, yeah, I think that market already bifurcated some time ago. The other thing to say is, if you look around Australia, there's no new retail. Nobody is building retail. So there's no new supply. You're not going to see an oversupply in the next 2 to 3 years. Anything that's in the market is in the market. It's relatively easy to maintain and upkeep. So, yeah, we love retail. It has been an absolute star performer for our business and other businesses like ours. So, yeah, it's the quiet achiever. And I think people need to take a second look at Australian retail.
All right, and Trent, you know, another sector that I suppose during COVID was heavily impacted, hospitality. You know, Phoenix are active in that space, and I think at last count, about 60% of transaction volumes in that hotel sector in Australia are from cross-border investors. So, I mean, are investors, I mean, obviously there's a lot of an improvement this year, a very much booming domestic tourism market. Are you seeing opportunities in that space, or are the operating metrics and you know, the energy prices starting to impact hotels?
I think we've seen a pretty strong recovery post-COVID. So we quite like the space. I think you've got to buy it at the right time. For us, you know, we wish we could have bought more, but we acquired one asset during COVID. To give you a bit of a flavour, that's a Pitt Street asset in Sydney. It's the Kimpton Margot. Please stay there if anyone's going. It's fantastic. No plug. But that's, trading at ADRs pre-COVID, back at where they were. And last month, I think it hit 65% occupancy. That's not where you want it, but it's probably better than we thought it would be at this time. So I think we're seeing a pretty strong recovery. I think in terms of future investment, it's got some pretty good tailwinds. The post-COVID, travel boom, as you mentioned. I think that we like, depending where and what, like the barriers to entry. So if you see the finance costs associated with building a new hotel, and you see the construction costs associated with building a new hotel, not many hotels are going to get built. So the barriers to entry are incredibly high, which benefits the obviously existing that can continue to be refreshed. Sydney, very low supply being added. Melbourne, a bit of a different story. So there's actually looks like quite a bit on the horizon, but who knows whether it's going to get up. Interesting space. We think it's a good sector and probably wish we did more in it during COVID.
Yeah, I certainly see. I've been booking flights and hotels home for Christmas, and I'm absolutely shocked at the pricing I'm having to pay. But I suppose my loss is your gain.
Well, Qantas's gain.
That's another topic.
Don't start me.
Yeah. I heard you had friends and families rates at your hotel.
That's it.
All right, well, we've got about 3 minutes left, so I just have one more question for each of the panellists, and in 30 seconds or thereabouts, can you just give me one thing that you're interested in, that you're excited about for next year? Maybe we'll start at the other end with my good friend Fergal.
30 seconds.
Well, I'll give you a minute because we know you like to.
Thank you. Look, I really like. I'm interested to see what happens to investors who are holding real estate, in particular office assets, where their interest coverage is going to get under pressure because of rate rises. And then what happens to those assets that have to be sold? That'll create buying opportunities for Singaporean investors, global investors that have cash that want to come in and refurb those buildings and make them bulletproof for the long run. I think that is going to be a significant submarket. I really do believe that. It has been the way in every other cycle. I don't see any reason why it wouldn't be the same way here. It's not distress as we've seen it in previous cycles. It's sort of what I call slow distress. People who don't have that negotiating power just have to shift the assets because the interest costs. I mean, cash rate was 25 bips in January. It's 260 today. This is not a sort of a small increase in your interest bill relative to your values or your leases. Your leases do not change that much in 9 months. That is going to cause some pressure. I'm very interested in watching those assets and how they get repositioned and what capital can come in and take hold of those assets, or maybe change them into the assets I think that we need in terms of residential. So that's the space I like. I already like logistics. I've already liked retail. But that's the new space that I'm keenly watching.
I was going to say that because we're an exchange, we are not tied to any one particular segment. So in the short term, we are doing a lot of short-term stuff, as in short-term papers. And in the longer term, we are looking at actually some residential projects and also branching into the medical space even within Australia. So we are fairly, have a fairly diversified view, but we're seeing quite a lot of flows. So we're fairly upbeat going into next year.
We have a number of residential projects that we'd be looking to start selling in 2024. So I'm looking forward to activating those or getting those into the market then. Working on getting those to the market next year, and hopefully it's a lot of a very different time in 2024 where the fundamentals can take over again.
We have a couple of large projects. I mean, Moorebank and Young Husband Wool Stores in Melbourne, which are starting development. So I look forward to seeing those progress in the next year. In terms of opportunities, I kind of agree with Fergal. I think there's going to be a lot of interesting opportunities in, regeneration, refurbishment, what people are now calling brown to green upgrading older properties, future-proofing them, increasing the green credentials. And I think we might see some interesting opportunities there.
All right, and with 4 seconds to go, I'd just like to thank the panelists, and I think we're on the home stretch now. We've got our final panel coming up, so thank you very much.